Let's bring in Campbell Harvey, professor of finance at Fuqua School of Business at Duke University and a partner at Research Associates. Campbell, great to have you back on the Schwab Network. Good to see you.
Good to see you.
Appreciate that. Let's talk yield curves first, because last year we talked about some of the doubts you had about whether or not this thing was really going to have that sort of crystal ball type of utility, but there's always kind of a range of timeline that we look at when it inverts, which was a while ago now, and now we're talking about possible uninversion. So how are you looking at it right now?
Sure. So the yield curve, as I measure it, the difference between the 10-year yield and the 3-month Treasury bill yield, that went negative in November of 2022. So what's interesting is to look historically at the lead time. So how long does it take after an inversion for a recession to start? And if we look over the last 4 recessions, the average lead time is 13 months.
Okay.
And we are at the 14th month right now. So we're in the middle of the 14th month. So we're essentially at the average. So it's way too early to say, oh, well, we did have a recession in 2023, so therefore the yield curve is a false signal. That's number one. Number two, and this is really important, that in the last 4 recessions, if you look at the yield curve behavior before the recessions, that in every case, the yield curve uninverted before the recession actually began. So those 2 pieces of information suggest that we're not out of the woods yet.
Okay. And an important point there is that even though we spend a lot of time in financial markets talking about the 10s to the 2s, the data you're drawing from are the 10s to the 3-month, which is much further away from uninversion right now than the 10s and the 2s.
That's exactly right. So my original dissertation used 10 minus 3 month. It is also popular to look at 10 minus 2 year. However, I don't really see a good reason to switch to the 10 minus 2 year for 2 reasons. Number one, my original indicator is 8 out of 8 without any false signals. So it's not like it's in distress and it needs a replacement.
Yeah.
And the other thing is the 10 minus 2s had a false signal in 1998.
Great point. Okay. So this is very useful for us, because if the 10s and the 2s uninvert, then people are looking at it, confusing it with yours, which when the uninversion happens, that's kind of the more imminent recession action, right? It's like actually happening. Then that means we might have a little bit more breathing room. But if we talk generally about the shape of the curves, what's fascinating is that since last summer, we've been bear steepening instead of bull steepening. It seemed like from my armchair analysis that almost, I think every time in that period you studied, we bear steepened we bull steepened. We bull steepened because yields came down as the Fed was cutting. But in the past year, we actually bear steepened. Is that right?
Yeah, that's right. And it's also the case that, look, there's only 8 recessions, so it's hard to draw inference, and the yield curve can invert or uninvert in different ways. But I think people generally agree that the sort of bear steepener, that's not necessarily good news. So again, let's be careful here. This is just one indicator.
Yeah.
So yes, my dissertation, it's done well, but surely we need to look at other information in the economy. And what I see points to much slower growth in 2024, ideally a soft landing, which would mean substantially lower growth, maybe a recession, but a mild one, like 2001, where we're in recession, but we don't even have negative year-over-year growth. That would be ideal. So I hope that this can be engineered, but there are a lot of headwinds that are obvious that go well beyond the yield curve situation.
Well, you're a humble man in downplaying the yield curve utility. Only 8 equals N, only 8 sample sizes, but still we've only had 8 recessions for a pretty long stretch of time here. To come back to the bear versus bull point, you don't think the steepening gives a different message depending on what kind it is? If the Fed has to come to rescue the markets versus the 10-year just kind of growing its way out if the economy beats expectations?
Yeah, so I think you can tell, that that's a narrative that's a credible narrative.
Okay.
What I'm saying is there's just not a lot of data. With 8 observations, you could look at different types of steepening, but it's really hard scientifically to draw inference from that. But I believe that your narrative is a credible narrative. Again, I would caution just looking at one indicator. This is just the difference between 2 interest rates. The economy is very complex. And again, what I do is I go well beyond that and look at other information.
All right. As a narrative builder, all I can ask for is credibility, so I'll take it. What do you think about the SOM rule that looks at the messages in unemployment rates of change? That's gotten a lot of attention. I'm sure you've spent some time looking at that.
Yeah, so the advantage of my indicator is that it was discovered in 1986, and it's got a long track record of out-of-sample validation. So at the time of publishing my dissertation, it was 4 out of 4. And then out of sample, it's correctly predicted 4 recessions without false signals. There are many other indicators discovered much later that look great in sample. So in the historical data, you can look at thousands of things, and some of them credible, some of them not. But the real test is to take it and test it during recession after recession after recession. And the indicator you mentioned, well, it might have some economic content. It just doesn't have the track record out of sample.
Okay. Now, looking at the overall macro outlook, the softness that you see coming, can that be averted by the market's expectations for the Fed if they live up to those expectations? What do you make of the way the market has taken a grain of salt from the Fed saying they're done hiking and turning it into this massive mountain of policy reversal priced in?
Yeah, so one problem is that the Fed has overshot. And if you read my LinkedIn, I've been on this for quite a while. So the excuse of continuing hiking throughout 2023 based upon inflation above 3% was a false narrative. Because if you were looking at real-time shelter inflation, the CPI was already below 2%. So we've overshot, and that has caused risk. And for me, the best thing that could happen is a very swift reduction in the Fed funds rate. So ideally, the Fed funds rate should be in the 3 to 3.5% range by year end. And the sooner, the better. The Fed needs to undo the damage that it did in 2023.
Okay. And as we look for that, how will we know it's happening? Should we be watching employment? Do you trust those signals today? Should we be watching the ancillary data? We've got an economy that's very much different in services versus manufacturing. What is your kind of ranking of data that you're watching right now?
So analyzing what happened in 2023 is kind of obvious. So the growth that we saw that surprised many people, and didn't surprise me, was driven by the consumer. And the consumer is 70% of GDP. And what was the driving force? Well, 2 things. Number 1, pent-up demand from pandemic lockdowns. And number 2, government policies that provided some extra savings for consumers. So throughout 2023, the consumers' savings got run down. And it is at a very low level right now and pretty well at the end. So the ending point for me, a leading indicator, is to look at things like credit card and auto loan delinquencies. And those are heading up. And surely if the interest rate on your credit card is 20%, you're only paying that if you don't have any savings. So I don't think that the consumer will bail out GDP growth in 2024. It's just not possible. And there's so many other headwinds, like the tens of millions of people that all of a sudden have to pay their student loans down again. They had a holiday from that. and that instituted in October of 2023. And there's also the issue of credit. And we've seen a massive flight of money from savings accounts into money market accounts. So why would you keep your money in a savings account at, let's say, a too big to fail bank at 2 basis points annual rate when you can get over 500 in a money market mutual fund? So that reduction in deposits will eventually yield a credit squeeze in 2024.
All right, we appreciate the thoughts as always. Know you got to run to a meeting. The students wait. Thank you very much for your time, Campbell.
Thank you.
Appreciate it. Campbell Harvey, Professor of Finance at Fuqua's School of Business at Duke University.